Today's episode is presented by Lodestar, the fee experts.
Hi, everyone. Welcome to this week's episode of Lending Leaders. We have a great guest for you today. Longtime friend, fellow New Englander, Jeremy Potter. I guess New England transplant because we're both out of New England now. And Jeremy, I'll try to cut this episode short by cutting your intro short. Mortgage tech founder, consultant, advisor, attorney, chief strategy officer, board member, probably leaving a few things out, but, been all over the industry. Great follow on LinkedIn. Really excited to talk about all things mortgage and technology with you today.
Thanks, Jim. Great to be here.
Yeah. So, how'd you get into mortgage coming out of law school?
Yeah, the Dodd-Frank Act. So I was in Connecticut, UConn Law School, and there were two major. I had some government regulatory experience because after undergrad, I'd actually gone to DC and done some work inside the Beltway. And so I knew the government well, and I knew I kind of wanted to be on that line between the government and people, whether that was government and business. I did some constitutional law work my first year. And anyway, during my experience, the Affordable Care Act and the global financial crisis were kind of going in parallel. And I had some fun in law school looking at both. And once I graduated, I had a role with a law firm in Hartford that wanted to do consumer protection bulletins. What is the CFPB? Who is Elizabeth Warren? Who is Richard Cordray? And so I was the sort of contract associate, just like writing those briefs. And a mortgage company saw one of them and saw some of my other writing and said, why don't you just come and help our industry? You know, we need compliance. We're thinking about hiring a compliance attorney. Would you ever consider, leaving the law firm? And I couldn't be more excited to get into a business. So I joined Norcom Mortgage and Insurance right at the Dodd-Frank moment, and then walked the company through all of the disclosure compliance and amendments that followed 2011.
Wow. Then we share that in common. I also got into this industry because of Dodd-Frank, because I got called by my family's title company to build a good faith estimate calculator, which in January 1st, 2010, which was very much, one of the mandates that came through that. So, with that, then you kind of went into you said happy to be in a business. Now I feel like you're really associated with both innovation and technology. So did that kind of establish as an interest or a necessity in working in these companies?
Yeah, I'm glad you asked. One of the things that I felt was coming with a lot of the Dodd-Frank compliance was the role of technology in the process and the role of technology as it relates specifically to consumers, of course. So the opportunity came for me to move from Connecticut and join Quicken Loans. And I spent 2.5 years as the attorney for the Rocket Mortgage platform. If you remember when it launched, it was simply a digital application platform. It quickly became the flagship and the identity of the whole company, as we know it now.
I remember that Super Bowl ad well.
That's right. So the Super Bowl ad is what triggered their need for an attorney, they thought, and somebody to just be dedicated on technology. And I was thrilled to be that person. I always appreciated technology. I could never declare that I was a technologist, but I felt I was a tech enthusiast. And so I spent 2.5 years on the legal side, getting Rocket Mortgage all set up and operating sort of consistently, at which time I was able to move into the capital markets. Rocket Mortgage Capital Markets was really connected to the DC office of our government affairs, Fannie, Freddie, FHFA, you can imagine. And so I got the great opportunity to kind of speak mortgage and tech to legal and policy and vice versa. And my role as strategy and innovation at Rocket Mortgage meant I could really apply those technology innovation and policy things with a legal mindset or with a legal background. Job of a lifetime. And I really enjoyed it.
And that's wild too, that it's, having that legal experience, that compliance experience. And they're like, hey, Jeremy, we're just going to put you at the vanguard of industry technology right now, which is Rocket Mortgage, which everyone is either going to be suing us about or trying to copy or both.
Yeah. And I think that the biggest indicator that it was going to be the highest profile thing in the industry was that the CFPB tweeted at the commercial during the game. So like when you have that type of real-time response from the regulator, there's going to be eyes on it. And so that's what happened. And a month later, I was on board.
And one of the posts that you said about innovation that I really like is everyone wants to be the fastest second mover, right? I think that's very apt for the industry, right? We don't want to be Rocket Mortgage for the most part, right? We don't want to kind of get live tweets from the CFPB if we can avoid it. But once we know that works, we want to be as far in line as possible. Do you still see that happening? And, are there folks that are being more comfortable kind of being that first person if you're not the size of Rocket or like a UWM or something like that?
Yeah, it was a hard lesson for me to learn because the technology, like what a lot of people now call big tech, but when, the VC world was pumping money into technology in the Bay Area, everybody wanted to be the first. Everybody wanted to be the first of something. And then all of the VC world was, I want to be the Uber of blank or the Facebook of blank or the whatever of blank. And so that's the mindset I kind of brought to technology in the mortgage space. And it was a hard lesson for me to learn. So that post was years of bumping my head against a brick wall to then admit somebody has to try some things, but everybody else wants to ask you, who else is using it? And I thought that was an interesting question, but that is still the question to this day, especially independent mortgage companies, who else is using it? Because I want somebody else to take the first walk through the door.
Well, and then for startups, me, starting Lodestar from my New York City apartment, you kind of get into this chicken or egg dilemma where no one will work with you until you're working with someone, but you can't work with anyone because no one's going to work with you, right? So it's very tough for companies to get started in that unless you're part of a larger company or have a track record or something like that. So it definitely then makes things difficult for more and more innovation in this industry and more people enter it.
Yeah, it's exactly right. I think your experience is one where you got to be creative. And I know that, your discipline, creativity is what other founders have had to do as well. Often I'll tell founders that it's not that different from being an actor in Hollywood. You're going to get no after all these auditions until you get that one part. And some people get the part that then propels them to be able to sit back and never audition again. And some people don't. And it's very similar as a startup.
Yeah. Then you think it's a big role and then you end up on the cutting room floor anyway and nothing happens, right? Nothing goes
Exactly.
I like that analogy. Yeah. I mean, you look at the success rate of companies that start, right? It's probably a little better than actors, but not by much, right? At, 10 to 20% of the companies making it in some capacity. So it's interesting. So, it seems like there's a lot of this lack of innovation, kind of like there's a lot of things baked into the industry as a status quo, right? And you had mentioned one of that in a post that is near and dear to Lodestar's heart about cures and preventable expenses, right? So we'd love for you to kind of talk about what went into that of people just assuming like, I'm going to take this on the chin for these files. Like, why are they kind of assuming that some of these things are cost of doing business where they're really not?
Yeah, one of the things I've been lucky to do is work across title and mortgage and title insurance companies. Like you mentioned board seats. I'm on the board of Caddick in Connecticut, but then also working with companies like Silk Title backwards into a digital lending ecosystem. And being on the mortgage side brings new perspective to Caddick and others. And so for me, it was this question of how does the LOS, how does the sales process inform what you know when? And so a big process for me over the last couple of years has just been mapping. What do we know when and why? And I think the way that linear process is set up, the traditional loan officer experience of like, what do I need to do my job to get this to the next milestone or the next person in line, still informs our technology and it still informs many processes at many lenders. But you also have digital sort of coming at both sides, right? You have digital tools, closing, remote online notarization, some of the other QC, closing quality and risk management tools working backwards. And you have, of course, point of sale and digital application tools working the other way. And they're kind of crashing and to meet in the middle. So
and you just slap an AI underwriter in the middle, right? And let's see what happens.
Yeah. So when I called it brackish waters, I sort of meant that you've got this turbulent process meets technology. And what ends up happening is unless you're willing to reevaluate your human processes, you are going to have cures. So you have to apply technology at the right time up front. And that means you can then honor what you've installed all the way through to closing. If you can't do that, or you're unwilling to do that, or your salespeople won't do that, then you should just accept yours, not as preventable, but as part of what you've chosen as your process. And ICE's paper was not talking about it that way. And so that was the distinction I was hoping to make. I will also say, though,
we'll also use Lodestar, and those cures will go down quite a bit too. That's why we like that ICE papers.
Well, right. So that's
this is a problem we're solving. Like it shows some great data there. But sorry, go ahead.
No, absolutely. I understand what you're saying. Like there is a partnership aspect here, which is what do you expect a lender to be good at? And what do you expect them to know when? So the more you find partners where you can get data and tools up front, the better. And so that's where where I'm having conversations with lenders about exactly that.
Mm-hmm. Oh, and I think that makes a lot of sense and also hurts the innovation and adoption to your point earlier. I know people have looked at the cost to originate going up now, 11,000, 13,000, even 15,000 for banks and credit unions. And everyone says, oh, all this technology and it's not making stuff any cheaper, right? Because you're throwing it at crappy processes, right? I think there's a Bill Gates quote, if you take an inefficient organization and put technology on it, it's going to get more inefficient, right? And I think that's what's happening in a lot of cases, right? They're just making that problem and making it worse. So,
that's exactly right.
And, you get an aging workforce that doesn't want to implement these things. I don't know how this guy got my number, but it was actually one of our users. I usually don't talk to an LO at one of our clients, but he called me saying he had to redisclose. It's like, oh, my company's, I can't send out my disclosure until I quote you guys. I know this makes sense for like people who are new, but I've been in the industry 25 years. I've seen everything there is. I just want to know you guys won't overwrite my fees. I was like, okay, well, did you run a quote yet? No, I didn't run a quote. Okay. I was like, okay, well, you can run a quote and send our team an email. We'll respond to you quickly. He's like, oh, I don't have time for that. Right. So, I also feel the pain of these mortgage folks trying to implement these things and, dealing with some version of that in a lot of cases.
Yeah, it's really a question of incentives. What gets you to change and why? Mm-hmm. And I think we've had hesitancy on the part of particularly traditional retail that is not willing to change the incentives relative to modernization or technology. And until you do, you're going to struggle to compete with digital platforms that have done that.
Yeah. And where do you think that's all heading? Do you think there's just going to be the rich will get richer in terms of the people getting faster and better, and then ultimately people either have to adapt or change?
I have been saying a lot that the big get bigger. Consolidation, anytime there's disruption, uncertainty in the market, capital size does matter. And I think the big get bigger. So the consolidation we used to worry about, I thought, was small and mid-sized lenders having to close up their doors and go away. What I'm realizing as this market shifts is it's actually the bottom half or the bottom third of every company. So you're going to see the biggest performers are going to get bigger. The biggest performers at rate are going to get bigger. Yeah. The bigger performers at Loan Depot are going to get bigger. And it's actually going to be the smaller performers within each shop. We'll see some consolidation there.
See that. Yeah.
I think that people don't necessarily want to avoid people, ultimately, customers or loan officers. Yeah. The key, though, is I want what I want when I want it. I tell a lot of people, don't forget, we're consumers too in other areas of our lives when we're not working. We want what we want when we want it.
Right.
And there's no reason mortgage shouldn't live up to that. And sometimes people want a person when they want it.
Usually
that has to be that has to be available. A lot of people like to paint me in a corner that I'm tech only, digital only. That's not the case. What they don't like to hear from me is how hard and complex it is to build an experience and build a process that meets your cost expectations and your efficiency expectations and still gives the customer what they want. And you have to be honest about both. And that's really hard. I get it. But that's where you win. And so that's kind of what I talk about a lot.
Which gets me to my last question of what's your lodestar? What's your kind of motivator, guiding star when you get up doing all this work, talking about innovation? Clearly, you're very passionate about all of this in the industry.
I just believe that we have a better way to interact with consumers for them to understand what can I afford and what is the best decision for me. And sometimes that's buying a house. And sometimes that's buying part of an asset class or buying part of something else. And sometimes it is really just a dashboard where you understand. We don't have good economics today for working with consumers longer than 60 or 90 days. All the economics in the industry are kind of built around a very short window of time between 30 and 90 days. So my passion is to figure out a way to unlock process and economics that let you work with the consumer kind of the way we should and still have it benefit and make sure that we can make money as an industry, not go out of business. That's what they'll tell you today. I can't work with a consumer for 2 years. It's too expensive. We've got to unlock incentives and economics that pull the technology forward, pull that service forward, and let consumers see what is really going on in my financial life, what's really going on in the real estate life, put those together. And then I have a real strong picture, because my belief of the American Dream 2.0 is it's about ownership of assets. Many people will still decide that is a real estate asset. Almost everyone may still say that's a residential real estate asset. But it doesn't matter to me, because I'm saying, how do we get more equity into the hands of more people? You got to own something in this economy. If you still want it to be a house, let's make it a house or part of a house or interest in a house or something. But let's find ways. And if we do the technology right, we can be way more flexible with people's lives. Right now, it's very strict. One size fits all, 30-year fixed with this credit box. And we got to do better in the next generation.
And I think that's great. All this, talk about technology, you really want to use technology to turn this into a relational business, not a transactional business, right? Like, how do we use technology to push the relationship? Because that's one thing AI is not going to replace. It's two people talking together and getting that relationship. And it can actually make it better, but you have to be thinking about it the right way.
That's right. When I think of the best brands, that their customers have a relationship with them or believe that they do. They're proud of that brand. We don't see a lot of pride in the brand in financial
holding
services
my Apple,
and mortgage.
my iPhone up, right?
Exactly. And I believe that's possible. We can make people happy with their mortgage financial services brand, and we haven't seen that done yet, but we can do that.
No, that makes a lot of sense. Well, we'll both get down off our soapboxes here since we're over time, but I really appreciate it. We'll have to talk again, Jeremy. Great for coming on. Where can folks find you if they're interested in hearing more?
Thank you, Jim. Great to be here. On LinkedIn, as you mentioned, is a really great place to find my writing and some of that other stuff. I also have a podcast that I would mention on Spotify, Apple, and YouTube called Housing Insiders. So check out Housing Insiders wherever you get your podcasts.
Great. Sounds good. Well, Jeremy, thanks again, and talk soon, everyone.
Thanks, Jim.